weigh in. If they don't, that shows that they don't care, or it might be interpreted as having, I guess, the wrong opinion about these types of things. The truth of the matter is that silence is not violence. Silence is simply silence, and it's often prudence. What we need at more universities, and certainly corporations, is that we need leaders to say, I don't have an opinion about everything. I do personally, but my corporation is not competent to be weighing in on everything. We need policies of saying less about current events. We need policies of saying less about political issues. Now, what's happening is that activists are bullying leaders. They're bullying them to say things that they want them to say. And if it looks like they have enough power, then when the leaders are leaning into this, they wind up actually getting on the wrong side of all kinds of issues.
But let me give you two examples where maybe it comes into business. Maybe you believe it's about character. You talk about character. You talk about morals, about people having a moral code. You saw Bill Ackman last week. Similarly, now Ken Griffin in today's newspaper saying, I don't want to hire people like this. I don't want to hire people who are part of these groups that have signed letters saying that that Israel is responsible for what's happening there. That it's not Hamas. People who are not condemning Hamas and saying, why should we have these people working in our offices? Others have come out. You know, Larry Summers has said. Some of those folks who signed those letters might have made mistakes and the like, but you can see how this becomes a business issue quite quickly.
Right, for sure. And you know, the key thing to understand is that when employee groups actually speak as if they're speaking on behalf of the organization, then the leaders have to say they don't speak on behalf of the organization. Nobody speaks on behalf of the organization except the leaders of the organization, and to distance themselves from those people. Look, the people who are signing letters on one side or the other of the conflict, they're responsible for their own signatures. But the university itself, or the company that actually houses these groups, is not responsible for them. We have to make a policy of saying that people can't speak for us. Don't make any mistake about it. These are not our opinions.
But what do you, this whole idea of silence, you know, especially on an issue like this, which is so barbaric and to me so disgraceful and so straightforward in my mind, and maybe, look, there are people who can disagree. And by the way, there's a fair debate to be had about what type of retaliation should take place, what that looks like, how that works. I think people can have that conversation. But at the same time, to not look at what Hamas did to these Israelis, to be dragging grandmothers and shooting kids, and I mean, it's so horrific. Why should a corporation be silent? Shouldn't a corporation stand up and say this is absolutely 100% wrong?
Yeah, no, this is absolutely 100% wrong. It's absolutely the case that, and I believe we should stand with our sisters and brothers in Israel in the face of this barbaric terrorism, of course. But the point of the matter is, I don't think Americans are sitting around their homes saying, I wonder what the CEO of Kentucky Fried Chicken has to say about the terrorist attacks. The truth is that people have these opinions. People have, I think, normal opinions. They have the right opinions for the most part, and we don't have to look to corporations that, or even universities that are dedicated to inquiry, not to advocacy. I think we can imagine the decent people are on the right side of these things, and we don't have to say everybody must get on the record all the time, and therefore put their organizations on the record all the time. That's not the competency of organizations.
Arthur, how do you separate what the leaders of these corporations say from the organizations themselves? And I guess I would say we have so many people who come on the show and say that it's the business community's responsibility and business leaders' responsibility to stand up and show real leadership, because they say they find it lacking in Washington, they find it lacking in all kinds of other places around us. What's a business leader to do?
Yeah, a business leader has to actually focus on the business and talk about the actual values of the business as opposed to current events, social events, and political events of the day. There are lots and lots of cases where world events will impact the business itself. And in that case, it's absolutely appropriate. If there's something that's happening around the world and the company is involved in that part of the world, especially as it impacts the business, then they have to say something about it. But when it's unrelated, it's a distraction from what they're actually trying to do. The business of actually creating their product and jobs and opportunity and growth, and to say that everybody has to weigh in on everything all the time is a real distraction from all of us having the conversations that we need in this country, especially as citizens.
Okay, but turn this around. So we had Jonathan Greenblatt on the show from the ADL, right. Anti-Defamation League, last week. He is circulating a letter which he has been asking CEOs across the country to sign. There is clearly, and a lot of them have, and others have not, and there's clearly, as you said, silence is violence. There's a view, and maybe you think he's a bully. I don't know. I happen to agree with that side of things, which is to say that I would think that a letter that says that you condemn what Hamas did would be a relatively easy thing to sign. But I can't tell if you're saying that maybe you shouldn't sign that because then it gets you into sort of all sorts of other places, and that, frankly, from a business perspective, it's unrelated.
Yeah, so I've been asked to sign many letters. And as you know, I was a CEO for a long time. I was the president of a think tank in Washington, D.C. And there were a million letters that came across my desk with all kinds of things that I absolutely agreed with, and I didn't sign them. And the whole point of that was because I was leading an organization dedicated to inquiry about all different types of things. And each of my scholars and my employees, they had their own opinions. But my organization didn't have an opinion on things outside of the competency of what we were actually doing. So I agree with this. Look, I agree completely with the letter that the ADL is promoting. I completely agree with it. I would sign it as an individual. I'm just saying that corporations don't have the competency to actually take the organization in that direction.
Arthur Brooks, it is a longer conversation, and I hope we have an opportunity to continue it. It is always very good to see you. Thank you.
Thank you, Andrew.
Still to come this morning, we will talk markets and this week's earnings expectations. And later, former Atlanta Fed President Dennis Lockhart will join us to talk about what's ahead for the Fed in the wake of last week's inflation data. We'll be right back.
Above this 4,200 level in the S&P, which many have been watching. So you're right there, but you're also trapped below this sort of 4,400 level. So we're kind of in between here. And in fact, if you want to make it a little more kind of dramatic, these are the kind of bigger trend lines that we got to figure out which way we're going here. Now, the S&P is down, from 20 to 18 times forward earnings since late July, but also yields are higher, trying to figure out how that plays through. We'll take a look at the stock market's relationship to bonds right here. And this over the last 2 years. So the S&P 500, you see, has diverged from what is the corporate bond ETF. So this is basically how yields filter through to sort of the price of corporate credit. And you see, though, that the emerging markets index, as well as the small caps, they've tracked pretty well with bonds. So the high yields have taken a bite out of the prices and valuations in other parts of the market. But we know the S&P is largely supported by those mega cap growth stocks that have stable balance sheets, that are cash generators. They're not as susceptible to yields or even really every little turn in the macro cycle. On the financial story, we're still going to be getting some more bank earnings. You got some on Friday. Take a look at the financial sector as a whole, as well as the banks only. And you see this kind of divergence. This is over the last year. There's been a lot of chatter that since the market low last October, you've never had a, quote, new bull market without banks participating in it. And the banks, of course, are down, especially after that SVB shock in March. But overall, financials have managed to nose out a gain. Things like insurance have done okay. I should also mention Berkshire Hathaway, not a pure financial at all, is by far the largest component of the XLF. So you can treat that how you like. But also, I would point out trying to stay off the lows in the pure bank stocks as well, Andrew.
Okay, Mike, thank you. We will be keeping an eye on all of it.
Joining us right now for more on the markets is Oksana Aronoff, who is head of market strategy and alternative fixed income at JP Morgan Asset Management. And welcome. Thanks for coming in today.
Thank you.
Let's talk about the economy and what that means for rates, because that has to be driving every decision that you're making for investors right now when it comes to fixed income.
Absolutely. And it's really fascinating to me. We had, just a year ago, we were pushing 490 on the 10-year. We had a monster job beat. We had a couple of weak Treasury auctions. We had a beat on the PPI. We had a beat on the CPI. And yet we've seen a rally in Treasuries while risk sectors like equities, like credit risk, have actually continued to move up unabated, even on the events in the Middle East. We're seeing the Treasury rally give up some this morning, but really this is about the push and pull, right, between the geopolitical risks and the strength, the continued strength of the U.S. economy, as well as continued technical challenges to the bond story, to the rates story, and the fact that there are larger Treasury auctions. The Treasury is trying to finance tremendous deficits at a time when the largest sources of demand are stepping back.
Yeah, let's talk about that last part first. Just the massive deficits the treasuries need to get more and more money, bringing more treasuries into the market. I think last week's auction was maybe a little surprising with some of the stuff that went, especially with the 30-year. What do you hear from clients? Do they raise these same questions about concerns about, hey, what's going on with the deficits, and do we really want to be buyers at these levels, or we'll hold out for higher?
I think definitely those questions are coming through. They're coming through in the fact that that long end of the curve has been pushed up so significantly. The Fed has only raised 25 basis points since May, and yet we've seen this tremendous push up in the long end of the curve. So finally, right, the bond market is noticing the sort of financial underpinnings. The fact that, of course, the Fed has not been able to get services inflation under control, and now we're possibly seeing a reigniting of inflation because of, oil and some commodities, some other pressures. So we'll see how that plays out. But certainly the technical picture is an important one. We have, something like 30% of outstanding treasuries maturing over the next year and a half. You have the Fed selling $1 trillion of treasuries. You have the largest foreign buyers. China has been lightening their treasury load by about $300 billion a year since 2021. You have banks that are not net consumers of treasuries, right? And all of this is happening as the Treasury is trying to finance $1.5 trillion of deficit spending. So, and when you kind of pick up your eyes and look out over the horizon, right, in terms of secular trends, we're likely going to continue to see more pressures with respect to inflation, because whether you look at demographics, whether you look at some of the green energy initiatives, right, all of those things, the populist trend generally, globally, all of those things are inflationary in the long term.
At least there's got to be a floor that's underneath treasuries when it comes to the yields on some of these issues. Lee Cooperman told us last week at a CNBC conference that he wouldn't be touching the longer-term bonds below 5.5%, because he just thinks the trend is only up from here.
It makes a lot of sense, because historically the 10-year has really been the sum of growth, inflation, and a long-term premium of some sort. And when we just simply look at growth and inflation, right, that should bring us over 5%, and we're not there. And I've been saying that, look, the 10-year is still, even at some of its peak levels a couple of weeks ago, is still very much priced for a 2% inflation world. And if inflation does settle closer to 3%, then that will absolutely mean a repricing at that end of the curve.
So is that where Jamie Dimon gets some of the comments he makes about this, where he thinks, look, not that we're necessarily headed to 7%, but it wouldn't shock him? I think businesses should be prepared for it.
I think we're in agreement with that statement. Yeah, I certainly can't speak for Jamie, but I think generally we're in agreement that technical pressures, longer-term secular pressures with respect to inflation, and the fact that I think the Fed is just generally, I think Jay Powell is generally content to sort of demolish this really unhealthy relationship between asset prices, right, and Fed policy. And I think investors waiting for the Fed punch bowl to come back in the event of a slowdown will be wholly disappointed. So unless we see the economy in some kind of a free fall, yes, central banks will probably get re-involved. But a garden variety slowdown is not going to
They're not coming to the rescue.
No.
So what do you tell investors to do right now? How that's completely changed the paradigm of what we've gotten used to in the last 15 years or so.
Absolutely. So what we've been saying is that the next 10 years are going to be nothing like the last 10. There's going to be a lot more volatility to bonds. We're seeing it in the MOVE index, which is settling where we used to live pre-GFC. It feels like bond volatility is elevated, but really it is exactly where it used to live before the great financial crisis. And so we're saying, look, you have to preserve optionality in the form of liquidity, because it is paying you, but you absolutely have to attack opportunities as they arise, whether they're related to the banking sector earlier this year, whether they're related to commercial real estate as this year continues to move along. And one area where we think there'll be a very meaningful repricing is corporate credit risk, right? We saw the Rite Aid default this morning. Even before that, this year was already in the top, 5-6 years of defaults, and we're still, 3 months away roughly.
So it's
from
not,
the end
it's
of the
not
year.
pricing it in yet.
Absolutely not. Credit spreads are wildly optimistic about the default prospects. We've tripled defaults since the start of the year, albeit from very, very low levels. But the default cycle is underway, and we're going to continue to hear that drumbeat. So there's going to be some really interesting opportunities to get involved. And right now, you can sort of clip that coupon at the front end of the curve, but certainly there are things to do for investors with liquidity and with the toolkit to take advantage of the volatility in markets.
Not the sunniest news, but some interesting news for investors. Oksana,
great long-term returns.
Thank you.
Thank you.
Okay. Meantime, House GOP members expected to meet tonight in their quest to find a new Speaker of the House. It's currently unclear whether frontrunner Jim Jordan has enough support. The entire House scheduled now to take a vote tomorrow on the topic of the GOP. We have some news as well. NBC News will be hosting the third Republican primary debate. That's going to happen on Wednesday, November 8th at 8 p.m. Eastern Time. You'll be able to catch it on NBC television, streaming, and digital platforms as well. The RNC will announce who qualifies in the coming weeks.
When we come back, the latest headlines from Israel, along with a conversation about the country's intelligence gaps leading up to the Hamas attack and how counterterrorism could change as a result. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. We'll bring you the latest on the Israel-Hamas war. More than 1 million people have now fled their homes in Gaza ahead of an expected Israeli invasion. Last night on 60 Minutes, President Biden said he thought it would be a, quote, big mistake for Israel to reoccupy Gaza. Reports say the president is weighing a trip to Israel in the coming days. Currently, attention is on the Rafah border crossing between Gaza and Egypt, where people are trying to flee the violence and aid groups trying to get supplies in. Right now, I want to talk about Israel's intelligence failures leading up to the Hamas attack. Joining us right now for that is Andrew Bourine, is a former senior official in the U.S. Office of the Director of National Intelligence. He's executive director now of Flashpoint. Good morning to you. Let's talk about the failure, but I also want to talk about it in the context of the relationship, frankly, that Israel was trying to mount with Saudi Arabia. And one of the reasons I mention this is I think that Saudi looked at Israel as one of the great intelligence, national defense and intelligence countries in the world. And this is now putting that into question. When you look at the failure, where does it start?
Yeah, I mean, I think first off, what we need to focus on is not blaming any intelligence service, Israeli or any of the allies. I think that we need to zoom out here for a moment and recognize that perhaps there was a much broader policy failure and kind of a public perception failure that Hamas would be acting as kind of a rational, responsible state administrator in Gaza. They had more than 15 years to administer Gaza. They've had more than 15 years to prepare not only the terrorist attacks, but also prepare ambushes, prepare to use human shields. They took hostages from more than 30 countries. And right now, what we need to do is support those intelligence services as they seek locations, proof of life, any indications of movement of hostages, and frankly, also prepare to protect innocent civilians who will be in the way of what appears to be a very significant ground offensive coming. And that's all sides. There are more than 2 million people live in these regions where we're likely to see a ground war in the near future, right, where there, again, are possibly up to 200 hostages from more than 30 countries. And we at Flashpoint are actively monitoring chatter by terrorist groups aligned with Iran, by proxy actors aligned with Russia, by any really transnational organized criminal activity that could threaten those people or critical infrastructure in the region. But again, the policy failure, I think, is what is an inescapable conclusion. And right now, we have to keep morale up with intelligence services, not just in Israel, but from all of those 30-plus allied countries.
Andrew, you work with 50 different governments, 15 of the world's largest banks. What is the lesson for your firm in all of this?
Well, I mean, this terrorist attack by Hamas took the world by surprise. And I think one of the lessons we're watching is a couple of things. We saw, well, not significant, sophisticated cyber attacks. We did see some use of distributed denial of service or server flooding by sympathetic groups right in the immediate wake of the launch of Hamas's terrorist attacks inside of Israel. We are actively monitoring and we are observing a number of hacktivist groups, some of them aligned with Iran in the past, some of them aligned with Russia in the past. But we are seeing and keeping a very close eye on chatter for any expansion of cyber activity. And I think one of the concerns we have is that those actors backed by states, by adversaries, not only to Israel, but to other allied nations, could escalate and start attacking critical infrastructure, which would make life even much worse for innocent civilians who live in Gaza. Right. So we've really got to keep an eye on all kinds of issues. Right. And the last one I would add is the risk of global expansion of violence. So at the local law enforcement in those 50-plus countries that we work with and federal law enforcement, we are also actively monitoring and supporting any indications we see of lone wolf terrorism. We've already seen violence in France. We've seen violence in the United States targeting people on diaspora populations on either side of this conflict. And we're seeing a spike in anti-Semitism here in London and elsewhere. So there is a lot to watch out for. And for all of our clients, whether they are governments or in the private sector, we are very actively working to protect them, not only in cyberspace, but also their physical resources and their personnel wherever they are in the world.
Andrew, we keep hearing all of these lone wolf concerns and warnings about these things. Is this more of a warning or a watch at this point? I'm thinking of tornado watch versus a tornado warning.
Yeah, no, I think that's a very good analogy. I grew up in Minnesota. We get a lot of tornado warnings, and then it moves to a tornado watch when it's on the ground. And I think we are very much in a watching terrorist groups. We're also watching accelerationist groups in all over the planet, really, whether it's here in London or in Paris, Washington, D.C., New York City, any other global capitals where there are demonstrations forming. We know that adversaries of not only Israel, but of the United States, of free societies like the United Kingdom and all of the NATO members, we know that there are adversaries who will seek to accelerate conflict and generate political violence between groups. So we are actively supporting our clients also with help in identifying potential misinformation or disinformation campaigns. And we are cautioning everyone, not just our clients, but everyone, to be very cautious in terms of believing what they see on social media in the short term, because we are already seeing misinformation and propaganda campaigns from all over the planet. Anybody can contribute to that kind of chaos, even if they're not in the Middle East.
Andrew, I want to thank you for your perspective on all this morning. Hope to talk to you soon. Thanks.
Likewise. Thank you.
All right, coming up, oil authority Dan Yergin will join us to talk energy volatility in the wake of Hamas's attack on Israel. Stay tuned. You're watching Squawk Box, and this is CNBC.
We're out here at the National Business Aviation Association's big conference, and you're introducing the new CJ3 Gen 2. New business jet, can carry up to 10 passengers. What does it say about the market that you're seeing right now?
Yeah, this is our static display area at the show. Today we're announcing, actually simultaneously with this press release is going out, we're announcing a major upgrade to this airplane, the CJ3. We're calling it the Gen 2. This is the most comprehensive upgrade of the Gen 2s we've done. As designed by a customer advisory board, we're really excited about this airplane and the market. Modern avionics up front, more cockpit legroom for the pilots, new interior in the back, skylights, externally serviceable lab, just incredible upgrade for this airplane that our customers are going to be very excited.
This comes on the heels of you guys just locking in an order for 1,500 jets with NetJets. Big expansion, huge order. What are you noticing in the market overall, whether it's with fractional ownership or demand overall for corporate jets right now?
Yeah, we're very excited to get that deal with our longtime 40-year partner, NetJets. We've been discussing that for a few months. This is an extension of our current agreement, another 15 years. They're going to continue buying latitudes and longitudes and added in a new airplane, the Citation Ascend, which we just announced at eBase earlier this year. And so they're going to add in a third airplane. So that's more volume going to that. Your broader question about fractionals is they're very strong right now. That part of the market is strong. Some of these new entrants that came into private aviation, may have chartered an airplane for business or for leisure travel, are seeing the benefits, and I see a lot of them moving into fractional ownership at this
How much of this is being driven by companies that need to get to a small location because they're adding a manufacturing plant or they're expanding? And frankly, commercial aviation is not as an efficient way as if they have a fractional ownership or their own jet.
Yeah. The biggest part of this market is North America, and we're seeing other parts of the world as well. But yes, if you're going to a small or medium-sized city with no connectivity or limited connectivity on the airlines, travel there is very difficult. And we say these are productivity tools, and they are, and I think people are seeing a big benefit of that. And so they're adding in a fractional share so they can go point to point. Maybe a business that had no airplanes or had one airplane's adding a second or third because the need for their salesperson to go meet customers, et cetera.
But are those CEOs that you're talking to of these companies, are they worried about a possible recession and saying, I'm going to hold off on ordering a plane?
I haven't seen that yet. You know, this recession's been coming for a long time now. We've all anticipated it's not materializing thus far. I can't predict the future, but the confidence in this industry is really high right now.
And ramping production, any concerns about the supply chain?
Yes, of course. I think all industries are worried about the supply chain. I think it's really driven by the availability of skilled labor out there in really all industries. We're not immune to that. So the ability to ramp up the supply chain from raw materials all the way through, jet engines is driven by skilled workforce. And so companies are now going to invest in that. Workers are going to benefit from that in terms of increased pay. We're all going to invest in that in terms of training and workforce and retention and hiring.
Ron Draper, CEO of Textron Aviation, on a day, guys, where they introduce a new aircraft here, the CJ3 Gen 2. We'll send it back to you.
Okay. Thank you. Appreciate it. Coming up next, new manufacturing numbers. We're going to bring you those numbers from New York State and a look at the next set of decisions facing the Federal Reserve. Stay tuned. You're watching Squawk, and this is CNBC.
Look at the Empire State Manufacturing Survey. It's one that people are watching pretty closely just to see the economic activity here in the United States, see if we're seeing a slowdown. We have seen some other manufacturing numbers that have turned down recently, so we'll be awaiting this one eagerly. Ahead of that, you've got some pretty strong moves in the markets, the equity markets, that is. Futures for the Dow up by about 135. S&P futures up by 10.5. The NASDAQ indicated up by close to 14. And if you're watching yields across the Treasury market, you are seeing some higher yields this morning. The 10-year right now is sitting at 4.67. The 2-year is above 5%. You've got the 30-year at 4.84. Rick Santelli is standing by at the CME in Chicago. And Rick, take it away.
Yes, Empire expected to be down 6 is down 4.6, which is a less of a drop than expected on a month-over-month basis, and it really has been a very volatile series. Last month we were up nearly 2%. The month before that we were down 19. Actually, they're not percent. These are strictly numbers based on calculations, so it isn't a percent. But just to give you an idea, this year, the most negative was January at minus 32.9, and the most positive was 10.8. That was in April. So you can see how minus 4.6 fits in. And Becky's exactly correct. We have seen a lot of these turning a bit lower, Philly, all around the country, and that shouldn't be surprising. We want to pay particularly close towards the difference between service and manufacturing. And as for yields, right now, if you look at a 2-year, it's virtually unchanged on the day. The further down the curve you go, the bigger the moves are. So that's bearish because it's pushing yields up. We call this a bear steepener. We closed at minus 44, 2s to 10s. We've been as tight as minus 35. It's currently minus 37. The point is that long-dated Treasury yields have retaken the lead, moving higher. And it shouldn't be surprising because over the weekend, there wasn't as many stories as many were nervous about on Friday. And I don't mean, of course, to dismiss the human toll that's going on in the Middle East. But from a market perspective, Friday, many traders were reluctant to go home with any major positions, especially on the equity side. And I think that explains the big green going on at a time where yields are also moving higher. But at some point, you're going to watch those two markets, what I call it a relinking. And I think when they do relink, the driving force is going to continue to be higher rates in the long end. And it most likely will pressure some of that green as the session wears on. Andrew, back to you.
Okay. Thank you so very, very much. We got some hotter than expected inflation data last week, but Chicago Fed President Austin Goolsbee telling the Financial Times it's clear the overall slowdown in inflation is a trend, not just a momentary blip. Join us right now, former Atlanta Fed President Dennis Lockhart is now a professor at Georgia Tech. So is Austin right? Is Powell? Who is right in this? And what do you think is going to really happen?
I see it the way Austin sees it, and that is that we are in a disinflationary trend, but the month-to-month numbers sometimes jump around a little bit. The last report, the CPI report that came in, I thought it was consistent with that story, but it really didn't tell you very much. There was simply not a lot of new news in that report. So I think we can say, yes, there's a disinflationary trend underway.
Disinflationary trend underway that leads you to believe our economy is where in, call it, 6 to 12 months?
Probably weaker than it is today. We're coming off, of course, a third quarter that was, by most accounts, extraordinarily strong. And as Rick was pointing out in just his earlier report on the Empire State series, it looks like there are some indications that the economy is slowing. This is desired slowing from the Fed's perspective. But I do begin to pick up indications that maybe the economy is turning over to something weaker in the fourth quarter and going into 2024.
But we're saying weaker is good in this sort of perverse way.
And it is good in the sense that, first, the Fed has been predicting that they could not get to 2% without some weakening and without some effect on employment as well. And I think there is a certain scope for desired slowing, desired worsening of the economy, and then after that, of course, it changes dramatically when you get into the undesired scheme of things. And the Middle East developments, I think, present some scenarios that could put some downside risk into the picture. So it's a tricky period, I think, for the Fed to navigate.
At this point, when you look at the possibility of interest rate hikes, what does it look like to you?
I think they hold in November. I think at this, given all the circumstances in play at the moment, I think they would prefer to simply watch how the situation evolves. And I don't think there is a compelling case for making a move at the November 1st meeting. So in my expectation, and I think many people in the market believe this as well, they will not raise rates in November.
Hey, Dennis, we had someone from J.P. Morgan who was with us earlier who was just talking about how things are really going to be kind of putting a floor under Treasury yields, that there's so many things happening, the idea that the government is needing to raise more money to fund the deficits, just the idea that we have these deficits and the debt that is racked up on top of lots of other things that are kind of coming at this place. Is that your idea, too, that there's a floor on this and it's only going to go higher from here?
Well, the term rates, I think, under certain really adverse circumstances related to the Israeli situation could go lower because the flight to quality is going to push yields down as people are buying treasuries and buying the dollar as well. So I would expect volatility here to continue, and I think it's somewhat unpredictable. It depends a great deal on something that is really far outside of the scope of Fed control, and that is geopolitical events.
She also had the idea, though, that the Fed, that Jay Powell is really in the position where he wants to rid the market participants of this idea that the Fed is always going to be there to bring the punch bowl back, that if times get a little tougher, if the economy softens, that doesn't mean that rates are going to come down and that they will be stepping in, especially if it means to help asset prices.
Yeah, I can see that argument. At the beginning of your sentence, you said Jay Powell sort of thinking about how to interact with the market. And in my experience, so over several years, but now fairly dated, there's not a lot of strategizing about how to affect market rates, simply because it's so difficult for Fed action to actually produce a particular result in the market. So I think in a very general sense, you're probably right, but I don't think there's a lot of tactical thinking going on how to get a particular rate level or to somehow get the market to behave. And I think that, by the way, gives confidence to consumers, and consumers really drive the economy. So it's hard to see a recession in the near term, but I don't think you can rule it out given the total mix of factors out there today.
Dennis, I want to thank you for joining us this morning. Very
Thank you,
much.
Andrew.
Thanks.
An update for you folks. Drugstore chain Rite Aid filing for Chapter 11 bankruptcy protection. The company said that it would begin restructuring to reduce its debt. It said that it had reached a deal with creditors on a plan that includes evaluating its retail footprint and closing underperforming locations. Rite Aid also said lenders agreed to extend nearly $3.5 billion in new funding to provide liquidity. The company has faced slowing sales, mounting debt, and lawsuits accusing it of helping fuel the nation's opioid epidemic by oversupplying painkillers. Falling demand for COVID vaccines and testing have also hit the company's operations, which is that falling demand for COVID vaccines, something that Pfizer warned about on Friday. Saw a big drop in that stock on Friday, and last we looked, it was down once again today.
Meantime, the U.S. now planning to further restrict China's access to advanced computer chips and machines that make semiconductors. That's according to published reports. Any new measures would be in addition to restrictions announced about a year ago. China has accused the U.S. of abusing export controls. So the debate continues.
When we come back, the state of the global energy market in the wake of Hamas's attack on Israel and what we could see if the war escalates into a wider regional conflict. S&P Global Vice Chairman Dan Yergin will join us. And a reminder, you can get the best of Squawk Box in our daily podcast.
The S&P 500 looking to open about 19 points higher. Also, the NASDAQ up about 40 points this morning.
Check out shares of Charles Schwab. They've been moving a little lower this morning, trading actually near a 5-month low after reporting its third quarter results. Earnings came in at 77 cents a share. That was 3 cents better than the street was expecting, but revenue was down 16% from last year, and that was shy of expectations. New brokerage accounts were flat from a year ago, but down 7% from the prior quarter. You can see that stock is down only by about 19 cents, but 51.14. The stock is down more than 25% for the year to date, or for the 1 year, I should say. Crude oil fairly calm this morning, but Friday it posted its biggest daily gain since April. WTI and Brent each gained close to 6% as traders weighed the possibility of a wider Middle East conflict. This morning, WTI is up another 55 cents to 88.24. Brent is above $91. And Dan Yergin joins us right now. He is the vice chairman of S&P Global. And how much of this idea that this could be an expanding conflict in the Middle East is priced into the oil market?
Well, at this point, it's the expectation or the worry about it. Yeah. It was also the other thing that happened is that the U.S. started to put sanctions on people handling Russian oil. So those two things. So I think we're going to see this kind of volatility in the price until it's clear whether this is a limited conflict or whether it spreads.
I mean, on some levels, it's surprising that oil prices are not higher. This comes, I guess, after a pullback that we've seen recently just about the overall global demand picture.
Yeah, well, I think it's the demand side. I mean, it was a macro that was kind of pulling down the oil price. Now it's kind of it's holding, but no question that there's geopolitical risk in the price now that wasn't there a week and a half ago.
Dan, you have made some really interesting comparisons. You point out that tomorrow, Tuesday, is the 50th anniversary of the Arab oil embargo. Obviously, the attack from Hamas on Israel comes 50 years after the 1973 war. What's the same? What reminds you of the same of these things, and how are we different from?
Well, what's the same, of course, is that a massive surprise, both in intelligence and, as we heard before on the show, a policy failure. Secondly, it is deliberately choosing a Jewish holiday when people are at home and are specifically not supposed to be at work. So those two things are the same. What's different is this is not nation states that carried it out, but groups. The second thing is that in 1973, the U.S. was the largest importer of oil in the world. Now it's the largest producer of oil. And thirdly, very interesting, in 73 was the Arab countries that did the embargo. Now those Arab countries are in a dialogue with Israel, and the country that was supplying oil to Israel in 1973, Iran, is now the real adversary.
Yeah, I was going to say these are groups, maybe not nation states, but backed by a nation state, yes. Iran.
Right, that's right. I mean, it is clearly, I mean, the debate is how much was Iran deliberately specifically involved in it, but there's no question that this is one of the groups that has relied heavily on Iran for support.
So if we have those distinct differences, how do you think this plays out differently if the conflict expands?
Well, I think I think what the concern is disruption, and the concern is what happens with Iran. For instance, the U.S. could tighten its sanctions on Iran, and Iran could respond by seizing tankers. All of that would rise the price. And if the war generally spreads, then I think you would really start to see almost a real fear in the market that would really drive the prices up, because people don't know what's going to happen. But right now, it's kind of a holding with this geopolitical tension at this kind of level.
What worries you the most? What concerns you?
Well, I think it would be if this isn't contained, if it spreads, if it becomes a larger conflagration across the Middle East.
I mean, what's concerning on that front is hearing from just about everyone reporting from Israel right now, people who have sources there, people who have been following this for decades and decades, that this time is different because this attack was so brazen. It has solidified Israeli sentiment and hardened even people who were looking for peace before.
Yeah, I think it's transformed it, and I think it's the shock that you've seen on some of the what papers they've recovered from the assailants, that the October 2022, this was in planning for 2 years and simply was not observed. It was assumed in Israel that Hamas was looking inward. So it's an incredible surprise in the degree of organization and the lack of preparedness to deal with it.
We know what a lot of these Middle Eastern countries are saying, the countries surrounding Israel. We know what they're saying publicly. What do you think a country like Saudi Arabia is thinking?
Well, Saudi Arabia, I think, was really Crown Prince Mohammed bin Salman had said the other day, day by day we're getting closer to recognition with Israel. And so they see the dislocation of that as a real setback. And they have no love for Hamas, which is aligned with the Muslim Brotherhood and is aligned with their major antagonist, which is Iran.
We may be the largest producer of oil in the United States, and that is definitely different from 1973, but it doesn't isolate us from huge spikes in oil prices.
Absolutely. It is one global oil market, and the price will go up. By the way, we're just a year away from a presidential election, and gasoline prices will become politically very significant, what happens. So there's a whole domestic side to it. There's one other thing about 1973 and now that's the same. 1973, the U.S. was in a political crisis, Watergate. Well, we're kind of in a political disarray, particularly when you look at the Congress right now, and people around the world are seeing that too.
You know, we not only are not isolated from spikes because of the global market, you point out we're heading into an election. Gas prices are going to be very sensitive, but we don't have the SPR to fall back on now.
No, I mean, we've used about half of it, so it'd be harder to use it, and we're kind of getting to a level where you don't want to use it. So right now there is spare capacity, but it's primarily in the Middle East countries who are keeping a floor under the price of oil, because what's the key thing that's going on in the market, if you put aside the conflict, is that it's not China that has been the pressure on the market. It's the growth of non-OPEC plus production, which is actually matching the growth in demand.
I know it's really complicated to try and figure out where oil prices are headed based on the idea of whether or not a conflict in the Middle East expands. But what would you be telling people right now?
Well, I'd say, of course, it's on the one hand. The other hand, if things are kind of stable, then I think next year we're probably looking at prices in the mid 80s range would be what we'd expect.
That's the best case scenario.
Yeah, that's the best case scenario. That's right. Of course, in terms of a conflict, then the price that spreads and starts to affect disruption of supply, disruption also of infrastructure that's necessary for the production and transport of oil. Then we see the spikes, and the only buffer is really in the Middle East right now.
And the other problem with that is what it does for inflation around the globe and the...
Right, exactly. Sort of all the thinking about inflation and where we are has to be revived, and also the impact on the economy.
Mm-hmm. I have a question that has nothing to do with the Middle East, but I'm just curious what you think about it, because the other big issue that we've been talking about over the last several weeks is the UAW strike. And part of that has to do with EVs and the like. And this idea that maybe EVs are not going to come as fast, or it's going to be very expensive for them. How do you think about the EV world right now? in the context of the strike and how that's going to affect the price of oil or not in short term, long term, anything?
Well, of course, the strike is also what's going to happen to the jobs because you need less people to produce cars if you're making EVs. The thing that I focus on is the constraints on EVs, that every electric car has 2.5 times more copper than a conventional car, that so suddenly metals become a strategic commodity in the way they're not. And I think when you look at the numbers that are projected by 2035, you see a lot of stress on the components, the minerals.
Component parts.
Yeah.
But not, and you think oil has almost no impact?
Well, I think when you get prices high, then people start to look at electric cars. Now we're seeing signs that maybe people are not as enthusiastic.
Right.
But the push to electric cars is primarily being driven by policy. Right. Saying you can't sell electric cars, non-electric cars in California after 2035. That's a pretty strong message.
The interesting part, though, is we've seen this in the past, just where SUVs and big trucks were not popular when oil prices would go above $5. Right now, they're the profit center for big three.
They're keeping the auto companies.
Right. It's what everybody wants, but that's because oil prices have been pretty tame, and as a result, gasoline prices have been.
Yeah. So consumers, not only at the pump, but also in terms of buyers, are definitely sensitive to what happens to the gasoline price.
Dan, thank you for coming in.
Thank you.
Dan Yergin.
Thanks. Coming up on the other side of this, what to watch ahead of the opening bell on Wall Street. Stay tuned. You're watching Squawk Box, and this is CNBC.
That was put on Earth. In particular, because those two companies are much more reliant on COVID vaccines than Pfizer is overall. But you can see the picture here. Moderna shares this morning off by about 4.4%. Novavax shares down by just 10 cents right now. Andrew?
Thanks. Meantime, Starboard Value has now built a stake in News Corp. We've been talking about it all morning. It's fascinating because they plan to try to push for strategic and governance changes to that company. It's according to the Wall Street Journal this morning. Of course, their parent company is News Corporation. The activists planning to push for the spin-off of the company's real estate division. And most interestingly, perhaps, it plans to try to urge News Corporation to collapse its dual-class share structure, which, of course, gives the Murdoch family voting power in excess of their economic ownership. Hard to imagine or understand why that family would do such a thing. But lots of questions are going to be brought to bear this morning because David Faber is going to be speaking with Starboard CEO Jeff Smith a little, I shouldn't say later today, but tomorrow about all of this. And he's doing that at the Active Passive Investor Conference.
Also, check out a tweet from Bob Iger pointing out that this is the 100-year anniversary of Walt Disney. He points out that a century ago today, Walt Disney and his brother Roy officially founded the Disney Brothers Cartoon Studios. So there you have it, 100-year anniversary. All right, joining us in the markets right now, we want to bring in Julie Beal. She is chief market strategist at Kane Anderson Rudnick. She's also a CNBC contributor, and she has a particular pet peeve. Julie, I'm going to say something, and you go ahead and go off on a rant about this. Hey, earnings have been surprisingly strong. We had a lot of beats last Friday.
Yeah, I mean, if I hear it, it's all we've heard, right? For probably the last 4 quarters is, wow, earnings have been surprisingly strong. The consumer has been surprisingly strong. I don't think anyone should be surprised, guys, when you think about the level of stimulus that's been pumped into the economy. Of course, we've been supported. But I think going forward, it's hard to say exactly where the growth is going to be coming from. But I think what you want to be focused on are businesses that have quality earnings going forward and that are protected in terms of being able to price against their goods and services. I think you're starting to see cyclicals peel off because investors are recognizing that in tougher times, these businesses are going to struggle.
We are looking at the Dow futures now indicated up by about 200 points this morning. I hear your point about being frustrated by beating lowered expectations again and again. That's certainly what we've seen to this point. If you're saying that you want businesses that have pricing power, where do you look? Because I think one of the big questions on Wall Street has been, yeah, you've had pricing power to this point, but will it continue?
Yeah, I think that's a critical point, right? Because if we think about where profitability has been, margins have actually already contracted about as much as they do in the average recession, right? It's been the dual pressures that you've been getting from higher wages and also commodity costs. So for us, we'd like places where margins are a little bit more stable. I think the kind of smaller niche software players that haven't gotten as expensive as some of the larger AI plays are interesting. I think of a Tyler Technologies which is serving the public school market, which is pretty stable in terms of its funding, or a Bentley, which does infrastructure software. Those are places that I think are more compelling, and they have real earnings already.
Julie, thank you for being with us, and thanks for getting through a lot very quickly. We appreciate it.
Thank you.
All right, very quickly, let's take a check on the markets, because we have seen the futures pick up even in the last few minutes. We started with the NASDAQ in negative territory. It's now indicated up by about 53 points. Dow futures up by 204 points. S&P futures up by 23. And we'll continue to watch this throughout the day. And we will see you right back here tomorrow. Have a good day, everybody. Right now it's time for Squawk on the Street.